Are Australia's housing targets genuinely achievable, or are government promises falling behind reality? I'm Dion Besser, and this is Beyond the Deal. With housing supply under pressure and government targets looking increasingly out of reach, new data raises tough questions about affordability, policy and the future of Australia's property market. Joining me now is Cameron Kusher from Kusher Consulting. Cameron, thank you for joining me.
Thanks for having me, Dion. Great to be here.
Jumping straight into it, let's start with housing supply and government policy. Are the targets that the government is setting achievable, and what more can be done?
They're really not achievable. If you look at what the Housing Accord target is, it's 1.2 million homes over a 5-year period. So that's 240,000 new homes every year for 5 years, or another way to look at it is 60,000 new homes a quarter for 20 quarters. That's a level of construction that we've never actually been able to achieve before at all, let alone consistently for a 5-year period. Now, it's not that this couldn't be achieved, but we haven't put in place the conditions to make it achievable. And the reason for that is, if you look at what's happened over the last few years, we've seen a very strong escalation in inflation. We've seen very high increases in construction costs. We've also seen interest rates move to their highest levels in more than a decade. So that's all conspired to make new housing construction less feasible, and that's leading to a lower level of new construction. And if we look at the latest data for the first year of the Housing Accord target, we're about 69,000 new dwellings short of what that target is. And the number of dwelling completions over the year was actually lower than the previous year as well. So we're heading in the wrong direction. I think the good news is, as interest rates come down, as those construction cost escalations slow, more new housing is becoming feasible, but we're still a very long way away from where we need to be if we're going to seriously hit that target.
So just touching on construction costs, do you actually see construction costs coming down, or do you think it's going to plateau a little bit and the market will improve over time with interest rates coming down?
I don't see construction costs coming down. If you look at the history of that data, there's very few instances where we actually see a fall in construction costs. Now, keep in mind that construction costs are up about 40% over the last 5 years. And all of that generally gets passed on to the end user, who's the person buying. So we've now got this situation whereby the cost of a new home, now there's always a premium for a new home or a new apartment, but that premium is much wider than it has been historically. And if you go and talk to a property developer, what they'll say to you is, we actually need to push prices even higher than they are at the moment to make things feasible. So to get more new housing construction happening, we essentially need that gap between existing home prices and new home prices to narrow. Now, if you go to places like Western Australia, Queensland, South Australia, where there has been really strong price growth, we are seeing a narrowing of that price gap. But in Sydney and Melbourne, and two biggest markets, both have a population of more than 5 million people, both have a lot of overseas migrants coming into those cities. That's where we need to be delivering more housing. That gap is still quite wide, particularly in Melbourne, where prices have actually fallen over the last few years.
All right, well, that's a really good segue into government grants and the 5% scheme that has just started 1st of October. It was actually brought forward from the 1st of January 2026 to the 1st of October 2025. How do you see that impacting property prices and buyer activity?
Well, I mean, it's too early to see any hard data on this, but anecdotally, the people that I've been speaking to and reading what they've been saying, so buyers agents and real estate agents, said that it's created a lot of demand under those price caps, which is not really surprising. If we look historically at what has happened when there's been generous increases in incentives for first home buyers have said, thank you very much, I'll take that. And they've started to buy more properties, and it's pushed prices higher. The home guarantee scheme is quite generous in that it allows you to buy a property with a 5% deposit, but not pay any lender's mortgage insurance. So it's allowing people to purchase sooner, but it's also, there's probably quite a lot of people that had already saved a 10% deposit or a 15% deposit and were wanting to buy a property, but they've now gone, well, actually now I only have to put down 5% and I can avoid paying lender's mortgage insurance as well. So it's certainly created a lot of demand. My issue with these policies are that they don't really address the fact that the core issue which is that housing is expensive. What we're doing is enabling more people to buy at higher prices rather than actually addressing the affordability concerns. And the other concern for me is, where do we go from here? The first homeowners grant in 2000 started out as a $7,000 grant to offset the impost of GST on new housing construction, and it's now evolved into a 5% deposit with the federal government covering your lender's mortgage insurance. Early next year, there's going to be a new scheme, the Help to Buy scheme, which you can put down as little as a 2% deposit, and the government will go shared equity with you on that property. Wow. And I think about this and fast forward another 5 or 10 years. What are the incentives we're going to have to be offering first home buyers in another 5 or 10 years if we just continue to provide these incentives that push prices higher?
Okay, so shifting across, I suppose, to investors and property developers, land taxes are obviously having an impact. Certain policies around the Residential Tenancy Act in different states, different policies, but how are you seeing these government policies and taxes impacting decisions that investors and developers are making?
Well, it's a big impost on both of them. We've seen in Melbourne and Victoria over the last few years, as the state government there lifted land tax on investors, and they've increased stamp duties and land taxes on overseas investors, that investors have pulled out of the market. So we've seen a lower level of new investors coming into the Victorian market, but we've also seen a higher number of investors exiting those assets that they have in that market as well. So it's interesting, because that's actually given first home buyers a little bit of a chance to buy. We've seen a higher level of first home buying in Victoria than we've seen elsewhere. But the problem, of course, is when you've got a very strong growth in population, and particularly a lot of that population growth coming from net overseas migration, you need to be growing the rental pool. And that's not what's been happening in Victoria. So we've been shrinking that rental pool when we've had a growing demand for rental accommodation because of the increase in population growth. Now, at the same time, when we talk about property developers, especially on the apartment side, if you look historically, when we were delivering a lot of new apartments, a lot of that was fueled by a lot of investors buying that properties and a lot of overseas investors buying those properties as well. Now, if we've got fewer investors and we've got fewer overseas investors, it's going to be a lot harder for new apartment projects to get up. And that's why a lot of the new apartment projects you're seeing now are smaller scale and are largely, larger 2 bedrooms and 3 bedroom product, as opposed to 1 and 2 bedroom product. And that's because developers realise that it's not feasible to deliver investor grade apartment projects anymore. They're targeting that owner occupier segment because that's the only segment that's active.
So, I mean, if you were to give property developers any advice today, based on the numbers and the data that you see, what types of properties should they be building to be able to get off the ground?
Unfortunately, it's still that larger 2 and 3 bedroom product. But of course, you've got to have the right site. You've got to be able to get funding and financing. You've got to be able to get pre-sales, and that's increasingly a challenge. The challenge for developers at the moment is how much construction costs have gone up, and then that gap that I talked about between existing and new home prices. So it's a harder sell to convince people to buy a brand new apartment as opposed to something that's secondhand. And the other big challenge is just feasibility. Development is a risk. Most developers will look for a margin of 20%. If they can't get that 20% margin, then they say, well, it's not worth my while taking on that risk to develop. So I think government really needs to look at, if they're serious about delivering more housing, how do we make new development more feasible than it is currently today? And that means looking at how quickly you can actually approve these projects, even in some instances how dense these projects can be, but equally looking at the fees and charges on new development and how that is eating into the margin of developers as well.
Really, really good advice. Let's talk a little bit about interest rates. We saw the unemployment rate creep up a little bit. We've seen inflation figures creep up a little bit in the last couple of weeks. How do you see this impacting the RBA's decision on interest rates, and where do you see interest rates moving into in 2026?
Yeah, it's a bit all over the place at the moment. So if you'd asked me a couple of weeks ago, I would have probably said no interest rate cut this year, and probably not only one more interest rate cut, and not till probably February or March or April next year. But with that unemployment rate spiking to 4.5%, that's actually a higher unemployment rate than the Reserve Bank has in its forecast period. Now, its forecast period goes all the way out to the end of 2027 now, and they only had the unemployment rate peaking at 4.3%. Now, we have seen this before, that we get a bit of a spike in the unemployment rate and then it pulls back. So I don't think they'll be reading too much into that one higher unemployment rate. In saying that, though, we have seen a big slowdown in job creation throughout this calendar year. And we know that a lot of jobs that have been being created have been from the public sector rather than the private sector. So I think they'll be watching it. I still don't think we're going to get an interest rate cut in November. And the main reason for that is, as you said, inflation has been creeping a little bit higher. And in some of their recent statements, the Reserve Bank have even said that they expect inflation to be a little bit higher than what they're forecasting when the September quarter numbers come out later this month. Now, if that's the case, I don't think we'll get an interest rate cut this year. Probably that will move into next year. We may get another two. But if it is surprisingly low, then that could give them the green light to cut interest rates as soon as November. But my base case is we probably get the next interest rate cut in February, and then maybe another one a few months or 3 months or so later in 2026.
So for all the buyers and the vendors out there now looking into the beginning of 2026, what advice do you have for buyers and what advice do you have for vendors?
Well, advice for buyers, it really depends. I mean, as we've talked about, there's a lot of first home buyers coming into the market. So if you're under that price cap, then the price caps are quite different in each capital city and each state. So in Sydney, for example, the price cap is 1.5 million. In Melbourne, it's 900,000. So find out what those price caps are. If you're under those price caps, there's probably an advantage to trying to buy sooner rather than later, because there's already a lot of competition and that's pushing up prices there. The biggest challenge, though, I think for a lot of people looking to buy at the moment is that low level of stock that's actually advertised on the market and available for sale at the moment. So we haven't got a lot of stock and we've got a lot of competition out there, and that's the sort of conditions you see when prices start to rise. In terms of vendors, it's really a choice for vendors. Do you want to sell this side of Christmas, where there are a lot of buyers out there, and we know that there's a lot of buyers, although it's getting very late now to put your property on the market if you want to sell before Christmas.
Yes. Or
potentially waiting till next year when prices are a little bit higher, but obviously there's no guarantee that demand for housing will be as strong in the in 3 or 4 months' time. I think it will be, but there's always a risk if you wait to bring your property onto the market that conditions can change.
Cameron, thank you very much for your time. This program was presented by Besser Co Estate Agents. I'm Dion Besser. Thanks for watching.